If all your money is in the bank, then I have some bad news for you. That is the worst place to have it if you are looking to build wealth. Want to know the best place to park your cash? Then make sure you stick around until the end. Jared here, back with another episode of Minding My Money Mondays, a common sense talk about money matters. On January 1st, 2020, $1 would buy you $1 of goods. But on December 31st, 2020, it took $1.04 to buy $1 in goods. Why? It's called inflation. And in 2020, the annual US inflation rate was 1.4%. So why is this important? Well, the average savings account at a US bank in 2020 paid less than 0.5% to an account holder in interest. So while it took $1 and 1.4 cents to buy the same goods, it only took $1 to buy at the beginning of the year. The $1 that you had sitting in a bank account could only buy you $1 and 0.05 cents in goods. See the problem here? With interest rates being at historical lows, if a majority of your money is parked in a bank account, you are literally losing money by the day. I mean, you might as well just set it on fire. Hey, does anyone want to help me burn my cash? No, literally, burn my cash. Now don't get me wrong, everyone needs to have some money saved just in case of an emergency. But beyond whatever that amount is, 1 month, 3 months, or 6 months of living expenses, it's not best for someone to park all of their excess cash in a bank. So Jared, where should I park my extra money? I'm glad you asked. You should invest it. Investing your money is kind of like saving your money, only there are bigger risks and rewards. You see, when your money is parked in a bank account, it's protected by the FDIC against loss. Not loss like inflation, but like if someone robs the bank, you'll still get your money back kind of loss. But with investing, well, your investment could crash and burn down to $0, or it could skyrocket to the moon to 1 million. And that's the risk and reward that you take when you invest. But investing doesn't have to be a crapshoot. There are ways you can invest with some predictability. Things like I-bonds, bond mutual funds, and REITs are known to pay their investors decent returns. This is why many people looking to create wealth add these things to their investment portfolio. Now, did you know that some companies pay money to those investors who own their shares of stock? Yep, they're called dividends. Better yet, did you know there is a group of companies that have consecutively paid increasing dividends for 25 plus quarters? Yeah, they're known as the dividend aristocrats. For example, the company AbbVie paid its shareholders a $4.72 dividend in 2020 for each share of stock that they owned. If a share of stock costs $85.71, then that's a dividend yield of 5.51%. Hey, that's a pretty good return on investment, and that certainly beats 1.4% of inflation. Don't have $85.71 to buy a share? Then let's look at another company. In 2020, a share of Franklin Resources cost about $21.76. That year, the company paid its shareholders a dividend of $1.08. So, a $1.08 dividend earned on a $21.76 investment is a yield of 4.96%. Once again, that beats 1.4% of inflation that took place in 2020. So the whole point is that using investment vehicles like dividend-paying stocks can be an option for you to park some of that money that you don't need for an emergency into something that can beat inflation. And if the price of the stock goes up, even better. You can then turn around and sell it for a gain. If you'd like to learn more about some of these alternative investment options, then check out this video we did on 5 investment alternatives to low interest CDs. Not only will it tell you some good places to park your money, but it will help you ensure that you build true wealth in the future versus letting the bank essentially burn your money. So like I always say at the end of every episode, it's been fun, it's been real. I'm Jared Rogers CPA, and until we meet again, let's all continue to mind my money, and I will see you all next Monday. Take care.